how about we first start with getting more into the different segments that S&P operates generally. And so each one, I think honestly, could be a viable standalone public company, granted all with different growth outlooks and risks too, which is what makes, I think, valuing S&P as a whole more complicated. And we'll try to get into that at the end of the episode.
Yeah, I think at least to international investors, S&P is probably best known for its index business. But the segment that drives most economic value, as I said before, is actually the ratings business. So S&P, like I said, is one of the major credit rating agencies in the world, and there are not that many. So Moody's, Fitch, S&P, those are always considered and have been considered for a long time as the biggest player in the space. And like I said, just Moody and S&P control about 80% of the market. If you also include Fitch, it's about 95% of the global market, so almost everything, with S&P covering 40% just on its own. And when companies or governments want to issue bonds, they really must obtain a credit rating to signal to investors how risky that debt actually is. So if bonds have no credit rating, many institutional investors are just legally prohibited from buying those securities. And I think it was in our TransTime episode when we talked about the difference between government-granted monopolies and natural monopolies. And just like with TransTime, I think S&P's rating division sits somewhere in the middle, where on one hand, it's one of only a handful of firms officially recognized by regulators as, quote, nationally recognized statistical rating organization, or in short, NRSRO. And that designation effectively looks into the global financial system, like banks, insurers, and pension funds, and they must use so-called NRSROs to meet capital and compliance rules. And new entrants almost never get approved, but even without these regulatory walls, the business would still be dominant by the same few players. I mean, credit rating agencies depend on decades of default data, investor trust, and just global recognition. And advantages like that, as a new entrant, you couldn't replicate them and you couldn't build them overnight. So there's definitely a feedback loop here in which investors and regulators have come to accept ratings primarily from those three big agencies. And that kind of pushes more companies and governments that hope to borrow money to secure credit ratings from those agencies. And that just further entrenches them as the go-to sources for ratings, even in situations where it's not required to even use them. So some of the major bond indexes, for example, they only consider ratings or bonds with ratings from S&P, Moody's, and Fitch. Even banking regulators use rating agencies when they determine a bank's capital adequacy. So basically, that refers to how much capital or equity a bank must hold to absorb potential losses. And as you can imagine, if you are that entrenched in the financial system, that just creates huge barriers to entry. But still, despite all these competitive advantages and the barriers to entry, ratings is still a pretty cyclical business. So in 2024, for example, it grew about 40% year over year, which sounds great at first, but the main reason for that is that in 2023, you had a pretty slow year. So the most important factor for that is basically the change in interest rates. When interest rates go up, fewer people borrow, and then obviously that means that there's less demand for ratings. And when interest rates go down, that dynamic basically changes. And the current environment in which we just see interest rates going down again could therefore be bullish for S&P in the future, especially if we think this is an environment that pushes through at least a couple of years. That should be a tailwind for the ratings business for S&P.
I remember one of the first things I learned at S&P was if you had a government or a company wanting to issue a bond of a certain size, the price just to have S&P basically give it a rating could be $750,000 easily. And so when you think of it through that lens, the ratings business, I mean, the margins are fantastic. So there's 60% plus operating margins, which makes it the second highest margin business within S&P as a whole. And that's pretty crazy to say for a company where the lowest margin segment still boasts about 40% profit margins. And that's just a testament to the overall quality of the company. And what helps make the ratings business a little bit less cyclical than its connections to interest rates would suggest is that they have this mix of transaction-based and recurring revenue. And so when interest rates are high and issuance slows, they have these so-called surveillance fees for existing ratings that would provide a recurring base of revenue fees. And so the surveillance fee is charged annually by S&P, essentially for continuously monitoring that rating. And this includes reviewing a company's financials, updating models, holding meetings with management, and publishing rating updates if something material changes. For example, if a company takes on more debt or if earnings fall sharply. So in short, you have this sort of initial fee for creating the rating, and that can really drive the transaction-based side of things. And then you have this lesser recurring revenue from the surveillance fee that S&P just continues to oversee for thousands of corporate and governmental borrowers across the globe.
It's just a great business to be in. And just hearing about the price point of $750,000 for a rating doesn't make you think twice about why the margins are actually that high. And perhaps it makes sense to illustrate the natural moat that the ratings business has once more, because if you just look at it, you feel like it's more of a regulatory moat. And I would say what helps is just assuming that there's, for example, a new rating agency that can massively undercut S&P's prices. And then you kind of think about, okay, what would that mean? Intuitively, you would think that S&P's customers would just leave and get their ratings from this new agency. However, there's a big difference in your interest cost based on the rating agency that the company uses. So if a company issues, let's say, a $500 million bond that is rated by an agency other than S&P, Moody's, or Fitch, it will have to pay higher interest rates as if it had used one of those big three agencies. And that's the case because the bank just trusts ratings from those companies just significantly more. And that reduces the risk of the bond. And therefore, if the risk is lower, the bank is willing to give out the loan at a lower interest rate. And there's a natural moat just in that trust, right? A well-rated company can save millions in interest expense, but just getting a rating from S&P, so paying S&P a few $100,000, or as we just learned, $750,000 to be precise, for that assessment is just an easy decision, right? The money customers can save because of the S&P rating makes upcoming competition almost impossible. So just getting back to the number example, and you also see the chart of this example on the screen if you watch this on Spotify or on YouTube. If you issue a $500 million bond and you assume an 80 basis point difference between the interest it has to pay when getting a rating from S&P versus a lower tier rating agency, then just 80 basis points, which are just 0.8%. However, on a bond with $500 million, that can easily be a multi-million-dollar annual difference, an annual one. So let's assume you have it over 5 years. Each year, for example, you would have extra costs of, let's say, $3 million. And considering the cost of a couple of $100,000 for a rating, it would even make sense, economic sense, to go with an S&P rating, even if the competitor doesn't charge you anything for the rating. And I think that's as strong as a moat you can get. So investors, on the other hand, to also look at it from the other side of the equation, they rely on those ratings compared to risk across thousands of different securities, especially institutional investors like pension funds, insurers, or money market funds. They can only buy securities with a certain rating, and often a rating from the top three companies. So a large bond indexes that we mentioned before, they only take bonds if they're rated from S&P, Moody's, or Fitch. So on whichever side of the market you're on, everybody cares about exactly who rated the debt. And as Buffett once put it, some parts of the world feel they need rating agencies. And if you ask me, as long as that's the case, and I think it will be the case for a very long time, S&P as the largest rating agency in the world will probably still do pretty good.
Generally, S&P's business model is built around recurring revenue and bundling its products into long-term subscriptions. I think that's sort of a theme that is recurring as you look throughout the company. And so the ratings division is transactional by nature, but even here, revenue is split 50-50 between subscriptions and then one-time transactions. And so the transactional side, just to emphasize it again, comes from rating new issues, whether that's corporate bonds, bank loans, or sovereign debt. And the recurring side, on the other hand, is that annual surveillance fees and the kind of relationship-based pricing programs that keep the agency engaged with clients long after that initial rating is first provided. And so the beauty of that setup is how it balances stability with cyclicality. And so when capital markets are booming and companies are all rushing to refinance or issue new debt, ratings revenues soars. But even in slower periods like 2022 and 2023, where you have higher interest rates that are kind of cooling demand for issuance, the recurring surveillance fees keep money flowing in. And so that's why ratings remains just such a dependable profit engine for S&P Global for so many years now. And I think it's for similar reasons that, Buffett has loved his investment in Moody's. It just thrives in the good times and it holds up surprisingly well in the bad times. So there's a real moat and margin of safety around the business.